Hello. So today is chapter 3, probably my favorite chapter, where liquidity lives. So let me pull that up real quick. Okay. This is one of the most important things, personally, the way I trade. Price does not move randomly, it moves towards orders that must be filled. Markets move with intent, not emotion. Liquidity is the hidden driver of price. Orders create gravity on the chart. Understanding liquidity reveals why price moves. This chapter explains market intent. Precision begins with knowing where orders rest. So, this is very important because generally when the algorithm just takes over and there's low volume, you can sometimes see the market just move into these certain areas that are just filled with resting liquidity orders and resting liquidity. That's why also stop losses get hunted and all these kind of things do occur. That's why accumulation areas are usually the areas where liquidity is accepted, just like we talked about in chapter 1 and 2. And when it's not accepted, it moves higher or lower into areas with liquidity. It's going to be very incorrect, even though it seems like it wants to go back up to a certain area. It wants to find more liquidity before it pushes into that direction. So the first move can sometimes be somewhat of a distraction of the actual trend that is going to be continuing. Why this chapter matters. Most traders ignore where orders actually sit. Liquidity explains stop runs and sharp reversals. Price seeks areas of participation, which is very important. Understanding liquidity removes surprise. This concept unlocks future precision. Liquidity connects structure, time, and execution. This is the lens here. So this is one of the big ones, that this is how institutions truly move the markets, and on certain days like CPI and other things, you just see the market for some reason drop 400 points because there's some kind of bad news, or there's great news and the market, instead of shooting farther up, actually wants to go back downwards because the liquidity pockets are all those orders that want to be filled from a day before, because CPI actually becomes a thing before the market truly opens during New York Times or New York Stock Exchange open. So that means the market then goes back down to that area, finds all that liquidity, buys all of it up with huge millions and trillions of dollars of orders, and then it shoots back up to the area that you actually believe the market would want to go to. Sometimes it falls even lower because there's so many orders that have to be filled, so it has to stack, and it has to be a buyer and a seller. So a lot of people then don't sell, so they wait into those levels because they put a stop loss in or other things, but that huge level is and then mess up over time. What is liquidity? Liquidity is the ability to transact size. Orders waiting at price create liquidity. More orders mean easier execution. As I was saying, fewer orders means movement. So that's one of those big things. So that's why it can't shoot to the $50, but then it has to have that entire price range, and that's where we see these kind of moves. And this could have broken down, or because there's only one order, huge buy right here, which leads to this all the way buying back up into these levels. That's then what you kind of see of the market reversing into the opposite direction. Fewer orders means faster movement. Liquidity attracts price. Illiquid areas repel price. Markets search for liquidity continuously. Always. Buy side versus sell side liquidity. Buy side price. Like this area compared to here, that buy side. Sell side liquidity sits below price. Like here, stop losses. Stops often create liquidity pools. Highs attract buy stops, lows attract sell stops. Price moves towards these areas. Liquidity provides fuel for execution. That's when you see the market just reverts for some reason. It can be the VWAP because it's a fair movement average. So that's the usual price of where the market wants to be. So VWAP trades are also a great option. Stops are fuel. Stop loss orders are market orders. Stops add execution. Large players need stop liquidity. Stop enables size entry and exist. Obvious stops attract price. Stops are not protection alone. They're fuel for movement. So this is one of the big things. If the stop loss gets hit, and it's like a perfect stop loss, that's why it's one of those things of being in a simulated environment can sometimes help you out quite a lot, or not actually going down that route. If you don't have a stop loss in an actual Live environment, you got to think that you're actually letting your lower level of liquidity be your stop loss. So let's say you buy with $3,000. So if the market drops $3,000 of value, that is actually your stop loss. So it's going to be hunted a little bit as well. But if it's farther out of the spectrum, it's not as bad. Sometimes it pulls it kind of out of proportion, so the market can then veer down to that level. So it's one of those things. So it is actually plausible that your stops get hunted, but most of the time with the trends and everything, that doesn't happen too often unless your stop loss is literally 2 points right underneath it, which is not great. That's why people always wait to move their stop loss closer to that level, because once you are in a live environment and you're at $4 for a Tesla call that's at $10, and all of a sudden you're at $12, so you're in profit with your long, you move it to 10, your stop loss is now like at an average level that it wants to be at, so the market then goes into those directions. Why highs and lows matter. Highs and lows attract attention. Traders cluster stops around extremes. Equal highs increase buy side liquidity. Equal lows increase sell side liquidity. Price is drawn to unfinished areas. Extremes advertise opportunity. Markets test obvious levels. Psychological levels of like $10, $11, $12, $10.50, 10 or 1025, all those kind of things, psychological levels, they all make a lot of sense. And then there's certain numbers that just for some reason make a lot of sense in the marketing world, so people just place those and they work as well. Liquidity magnets. Liquidity pulls price like gravity. Equal highs and lows act as magnets. Range extremes accumulate orders. Breakouts often target liquidity first. Sweep clear orders. Reactions follows resolution. Liquidity explains fake moves. So that's why the market moves down right here and then starts going up this way, creating an IFVG. And then right here is actually a safe order, break of structure. You get a little bit of points once you retest it, and then it goes all the way up. And that's a very good trade right there. Liquidity sweeps, my favorite. Price accelerates into liquidity. Then you have this, the market shoots all the way up. This is a Q3 inversion, IFVG, shoots back down this candle, and then before the actual move downward comes, this happens. It shoots up one more time during the macro, so you gotta be careful, take your profits on the first one, be patient again, and then you can take the huge move down. Price accelerates into liquidity, stops are trading rapidly, participation spikes briefly, liquidity is consumed, direction often changes after sweep, sweeps reveal intent, traps are formed here. Retail versus institutional behavior. Retail places stops at obvious levels. Institutional seek liquidity, not entries. Retail react after movement. Institutions position before resolution. So this entire area right here. Retail fears being wrong. Institutions manage inventory. Bang, boom. Behavior creates opportunity. Liquidity changes by session. Open sessions increase participations. Low liquidity periods increase noise. Time filters reliability. Sweeps often occur at key times. Session opens reveal intent in our market, but active liquidity is way more important because that's actually buyers and sellers. So if you have liquidity from the New York market still being in your volume, it's one of the bad things. A little bit of volume from certain levels, and if you actually mark all those levels out as liquidity pockets before the market closes, you can see once there's enough volume, all of a sudden you see crazy shoot ups or crazy drops that just move into those areas because they're still laying orders from the algorithm from before. It's not like the algorithm gets updated every single day. It keeps moving with market orders and fills every single order it wants in the liquidity pockets. So that's one of the big things. Sometimes you just want to take it out right before it hits that profit target because it's still just laying liquidity. So if there's no real liquidity there, have an order executed. So it moves to those pockets, takes that level, support and resistance kind of idea. And if it doesn't actually have anything above the resistance or below the support, it will then be somewhat of a early profit taking method. Liquidity and structure. Structure shows where liquidity forms. Breaks often target liquidity. Pullbacks reveal unfiled orders. Liquidity aligns with structure shifts. Structure without liquidity lacks power. Liquidity confirms structure. Precision comes from alignment. So when certain things align, that's how an A+ setup gets created. When all your criteria gets hit, that's when you should get into a trade. Oftentimes, it's not always A+, and you're trying to make a little bit of money. You can do a little bit of risky trades, but depending on what your grade setup is, most days, all these things repeat, and they rhyme quite a lot. Common liquidity myths. Liquidity is not magic lines. Liquidity is not guaranteed reversals. Liquidity does not mean immediate profit or profit. Context determines outcome. Structure matters. Time matters. Risk always comes first. That's why I advise sometimes taking earlier profits when these kind of scenarios occur, because a winning day is a winning day, no matter how much it is. The institutional view, liquidity is inventory. Orders create opportunity. Markets advertise where they want trades. Institutions wait for liquidity. Execution requires participation. Logic replaces guessing. Patience is rewarded. As always, patience. Liquidity in action, range forms and builds liquidity. Price targets extremes. Liquidity is swept. Reaction reveals intent. Continuation or reversal follows. Clarity appears after resolution. Execution becomes cleaner. Key takeaways: liquidity drives price movement. Orders create gravity. Highs and lows matter. Stop fuel movement. Sweeps reveal intent. Liquidity connects all concepts. Precision begins here. So yeah, that's one of my favorite things. Liquidity trading. Hope you guys enjoyed, and go through this video again and through a wonderful rest of your week.